आज हम लोग कुछ एडिटोरियल्स देखेंगे और टॉपिक होगा लक्ष्मी विकास बैंक। आज हमने इकोनॉमिक टाइम्स, मिंट और फाइनेंशियल एक्सप्रेस से इस सब्जेक्ट पे मटेरियल को चूज़ किया है। इकोनॉमिक टाइम्स का एडिटोरियल हेडलाइन है You are welcome at Abbas Academy Live. Today we are discussing today we are discussing editorial, and it is related to Lakshmi Vikas and its merger with DBS. The Economic Times headline reads, now that Lakshmi Vikas Bank is out of harm's way, and Financial Express editorial says RBI does well to merge Lakshmi Vikas Bank with DBS. So here and final points of this merger has been discussed in Mint, and the headline is Lakshmi Vikas Bank rescue shows RBI's attempts to fill systematic gaps. All these three articles praise RBI's role and asks some questions also on decision of RBI. As usual, we will begin with some words. We have the word beleaguered here. Beleaguered means परेशान, troubled. Another word is quibble. Quibble means find fault with. बाल का खाल निकालना, नुक्ताचीनी करना. This is the meaning of the word quibble. And third word is flounder, means struggle, falter, लड़खड़ाना. As usual, moratorium. Moratorium is a very popular word. Temporary suspension or रोक. Fifth word is amalgamation. When we are combining two or more companies into a new entity, it is called amalgamation. And we come across capital adequacy ratio. It tells about the health of the company. Capital adequacy ratio is the ratio of bank capital and risk weighted assets. It This risk takes into account credit risk, market risks, and operational risks. Now we have familiarized ourselves with a few words and a term. Now we will go to Economic Times editorial first, and then we will, first of all, we will see a few terms from Mint because it will clear a lot of concept to us. Headline here is Lakshmi Vikas Bank rescue shows RBI's attempts to fill systematic systemic gaps. And in we can see gross non-performing assets as a percentage of gross advances 9.1%. In 2007 2008 it was 2.2, and 2018-19 it became 9.1%. The data shows a sharp increase in banks' bad loans following RBI's exercise to push toward NPA recognition, and unprecedented growth in loan advances post 2008 led to the creation of bad assets. Now it is clarifying a certain queries. What does moratorium mean for Lakshmi Vikas Bank deposits, and then it answers. A moratorium is essentially a temporary suspension of an activity or law until future considerations warrant the lifting of the levied suspension. Typically, they are lifted once the problems that led to a moratorium have been resolved. In the present scenario, the central bank has put Lakshmi Vilas Bank under a moratorium and capped its deposits at rupees 25,000. What brought Lakshmi Vikas Bank to its present situation? How Lakshmi Vikas Bank is in this situation? The lender's current situation is largely an outcome of ongoing troubles and its deteriorating financial position. The erosion of capital because of successive losses and an increase in non-performing assets led to an urgent need for the bank to infuse capital to ensure that it meets the capital adequacy norms. रुको रुको. Hello, hello, hello. Are you listening? Listening? Are you listening? Am I audible now? Hmm? Dear students, am I audible to you? Can you hear me? If yes, say पहले बिल्कुल नहीं आ रही थी. I think I would be audible right now. What brought LVB to its present situation? The lender's current situation is largely an outcome of ongoing troubles and its deteriorating financial position. The erosion of capital because of successive losses and an increase in non-performing assets led to an urgent need for the bank to infuse capital to ensure that it meets the capital adequacy norms and that it could continue to serve the needs of its depositors. For that, it tried to merge with several large players, none of which worked out. Here we have the term capital adequacy norms. What is this norm? Capital adequacy norms. First of all, we have just seen what capital adequacy ratio means. In fact, capital adequacy ratio was bank's capital, bank's capital divided by risk weighted assets. As per Basel 3, Basel is a place in Switzerland and the committee is headquartered at the Bank for International Settlement in Basel. We call it Basel 1, Basel 2, Basel 3. Under Basel 3, capital adequacy norms, it is 8%. And in India, for commercial banks, it is 9%. And for public sector banks, it is 12%. So Basel norm is the minimum which a country should follow for healthier bank, for the stability of bank. Now the third question is, what will be the new proposed merger with DBS achieve? What will the new proposed merger with DBS achieve? Issued fresh shares of the merged entity based on a predetermined formula. However, in this situation, the capital position of the lender has eroded, and with the bank having a negative worth, its shareholders will find their value to be written off. Now, we will see the editorial of Economic Times. Now that Lakshmi Vilas Bank is out of harm's way, and after the merger, Lakshmi Vilas Bank is out of harm. And now this is the crux of the editorial. Time RBI let some sunlight into its decisions. Now it is the time when it is expected that Reserve Bank of India will throw some light into its decisions, and we will know it while reading the editorial. There were some pertinent questions. In some cases, Reserve Bank of India hasn't allowed some other companies to merge with Lakshmi Vilas. Now it has allowed DBS to merge with. At the outset, let us be clear that a troubled Lakshmi Vilas Bank merged with another bank strong enough to recapitalize it adequately is better for the banking and payment systems of India than a bank continuing to flounder. We have seen the meaning of the word flounder. Flounder means struggle, falter, ladkhadana. The editorial at the very beginning, it is Lakshmi Vikas Bank and its merger with another bank is better for banking and payment systems of India, because if any bank is floundering, struggling, faltering, it is of no good. So the present merger is a welcome move. That said, was the amalgamation with Singapore-based DBS via an Indian subsidiary wiping out the equity of existing shareholders the best option possible? As we have seen, amalgamation, when two or more companies are combining and a new entity is emerging. In this case, just we have seen in some questionnaires in Mint that as we see The lender's worth in Lakshmi Vikas Bank is negative, and so equity of these shareholders will be wiped out. So editorial says, was the amalgamation with Singapore-based DBS via an Indian subsidiary wiping out the equity of existing shareholders the best possible option? It is questioning whether it was a best possible option or not, because after amalgamation, existing shareholders equity has wiped out. Unless the Reserve Bank of India clears the air, existing shareholders of the Karur Tamil Nadu based bank will continue to feel sadly let down. The editorial writes, as, as long as the Reserve Bank of India is not making it clear, existing shareholders of the Karur Tamil Nadu based bank will continue to feel sadly let down. True, there were some sharp operators among the bank's new crop of investors who probably deserve what has come to them, but its traditional shareholders should have got a better deal. The editorial says that the traditional shareholders of the Lakshmi Vilas Bank should have got better deal, as they have lost the value of all their shares. It is possible that the government wanted to send multiple signals through the move. Here, government might be trying to give multiple signals through this move, through the merger of Lakshmi Vikas Bank with Singaporean based DBS Bank. And what can be these signals? First signal is one, that India remains attractive to foreign direct investors. In the past, we have done some work that made that gave the signal that India is not a attractive place for FDIs. So through this deal, we may be correcting that perception. Two, that a foreign bank that sets up an Indian subsidiary instead of operating through a branch in India without a separate capital structure of its own is welcome to buy out Indian banks, com- complete with their extended branch network. In this case, what we see, a foreign bank that sets up an Indian subsidiary instead of operating through a branch in India without a separate capital structure of its own is welcome to buy out Indian banks, complete with their extended branch network. 3. That the government is capable of solving a banking problem without putting taxpayer money at stake. What does this mean? In fact, Indian banking sector, Indian banking public sector is already overstretched. And if we are accommodating and taking help of these banks to other banks in distress, then taxpayer money may be at stake. And so this move is capable of solving a banking problem without putting taxpayer money at stake. And four, India might have opted, at least for the time being, to stay outside the newly launched trading bloc Regional Comprehensive Economic Partnership RCEP. We know RCEP is of 10 ASEAN countries and 5 other countries that include China, Japan, Australia. India might have opted, at least for the time being, to stay outside the newly launched trading bloc, Regional Comprehensive Economic Partnership, but remains committed to deepening financial ties with Asia, particularly the Association of Southeast Asian Nations, ASEAN, of which Singapore is a leading member. So India is not isolating itself by not joining Regional Comprehensive Economic Partnership. It is dealing with ASEAN countries. Lakshmi Vilas Bank has some 560 branches. This is a valuable asset. It could hold enormous attraction to other foreign banks as well, apart from DBS. The editorial says about Lakshmi Vikas Bank. It has 560 branches and it has a valuable asset. It could hold enormous attraction to other foreign banks as well, apart from DBS. It would have been worthwhile for RBI to sound them out besides potential Indian investors. Why, for example, was Clicks Capital deemed an unworthy suitor? RBI would do well to abandon its old fashioned stance that for a regulator silence is golden. In fact, editorial asks RBI to make it clear its decision process. It should state its reason for taking a drastic step such as the present one. Arbitrariness in a regulator is not good advertisement for a how investor friendly a country is. In fact, it is high time for any regulator that it must be open. It must be very clear in its decision. Its decision should not be arbitrary or it should not look arbitrary because it will not give a good signal that India is a investor friendly destination. In this editorial, just we saw that the role of RBI is a good and welcome move because it saved Lakshmi Vikas Bank, but its existing shareholders' equity were wiped out, and the editorial exhorts that RBI should clear air as far as its decision making process is concerned, and further it emphasizes that arbitrariness shouldn't be the norm for a regulator. It should be decision making process by any regulator should be very clear, obvious, and not it should be clear only. It should appear also that it is impartial. Now let us come back Financial Express editorial on the same topic. We are seeing the same thing from distinct and different perspectives so that we can have a good idea of what is happening. The headline of the editorial is RBI does well to merge Lakshmi Vilas Bank with DBS Bank, Singapore based Bank. Move will protect depositors. Could have been done a few years ago when Lakshmi Vilas Bank first ran into difficulties. So, editorial is meant for advising and analyzing the things. The editorial begins. If the central bank owned deposit and insurance credit guarantee corporation that insures rupees 37 lakh crore of bank deposits in the country has seen its premiums for the deposit insurance shoot up 60% in financial years 15 to 20 and surpluses rise 2.2 times over this period to over rupees 98,000 crore. It is because RBI rarely allows banks to fail. The latest example of RBI arranging a merger for an about to fail bank is that of the beleaguered Lakshmi Vilas Bank and the India subsidiary of Singapore's DBS Bank. Here, editorial cites an example and says that RBI rarely allows banks to fail. And the latest example is of Lakshmi Vilas Bank, to whom RBI escaped from failing by allowing its merger with Indian subsidiary of Singapore's DBS Bank. While LVB's depositors are now allowed to withdraw just rupees 25,000 each for another month, the plan is that the merger will provide enough assurance to its panicking clients to ensure there is no run on it. Now Lakshmi Vikas Bank's depositors can withdraw rupees 25,000 each for another month. The plan is assurance to its panicking clients. Since DBS has a strong enough balance sheet, it had non-performing assets of 2.7% as on June 30 and a 16% capital adequacy ratio against a requirement of 9%. For commercial banks in India, the requirement is of 9% and DBS Bank has capital adequacy ratio of 16% and its non-performing asset is also only 2.7%. This will ensure the merged bank also has capital adequacy of 12.4 12.5% versus 0.2% of Lakshmi Vilas Bank. Of the new entity after amalgamation of Lakshmi Vikas Bank and DBS, their capital adequacy ratio will be 12.5%. For Lakshmi Vikas Bank, capital adequacy ratio is 0.2%, meager, very poor, and DBS it is 16%. And of merged entity combining both, it will come out to be 12.5% and it is above the minimum requirement of 9% for commercial banks in India. As per Basel 3, we have seen, as per Basel 3, the requirement of capital adequacy is 8% and that is the minimum requirement for any bank. In India, we have requirement of 9% for commercial banks, and for public sector banks it is 12%. And the rupees 2500 crore of additional capital that DBS will bring will help sustain credit growth of the merged entity, to quote the RBI draft scheme of amalgamation, and will come in handy in case a section of depositors want out in the short run. DBS Bank is infusing additional capital of rupees 2500 crore over even the medium term, given how strong DBS balance sheet is, assuming it can amalgamate Lakshmi Vilas Bank into its operations seamlessly, the latest depositor should have little to fear. For DBS, the addition of 563 branches and 974 ATMs will help expand its India operation. Now the editorial is counting the benefits for DBS Bank. India subsidiary will get 563 branches of Lakshmi Vilas Bank and 974 ATMs, and its Indian operation will expand. Indeed, while some are concerned that RBI should not have chosen to allow a foreign bank to take over an Indian entity, the central bank probably wanted to close the deal at the earliest. The editorial says that some might raise the question that RBI should not have chosen to allow foreign bank to take over an Indian entity. The fact that a state-owned bank was not asked to step in is good news. The editorial praises this decision, that state-owned banks have not been allowed to take over is a good news. In any case, given several other banks also have weak financial, there will be several other merger alternatives. In fact, with this example, we can proceed in future also, because as we see in India, other banks and financial institutions are stressed, and this model will be of immense use. If the acquiring bank is strong, it is likely to get central bank approval. In the future also, if some other bank need such type of help, central bank can give approval for strong banks to acquire weaker banks. If there is a quibble, quibble means if there is a quibble, quibble means बाल का खाल निकालना, find fault with, नुक्ताचीनी करना. If there is a quibble, it is that RBI may have waited too long before taking strong action. If there is any fault in RBI, it can be said that RBI has taken a lot of time in arriving at this decision. LVB has been trouble for several years now. It was more than a year ago that the central bank placed it under the prompt and corrective action framework that put several restrictions on its lending, as it had a negative return on assets for 2 consecutive years and didn't have sufficient capital to manage its risks. All of this made LVB a good candidate for a merger with a healthy bank. And by allowing it to continue to operate for so long, RBI was taking a chance with the depositors' money. In fact, RBI should have taken decision much earlier. Cooperative Bank, where RBI also needed to put restrictions over a year ago on how much money could be withdrawn. It was argued that the central bank couldn't do much more as it didn't have the powers to supersede the bank's board. But the same does not apply to commercial banks where RBI's power are quite explicit. In the case of commercial banks, RBI's powers are very clear, very obvious. While imposing a moratorium on banks, as was done for both PMC and Lakshmi Vilas Bank, helps ensure there is no run. Not being able to come up with a strong succession plan only hurts depositors' interest. The fact that a scheme of the fact that a scheme of amalgamation was announced for LVB within a short while of the moratorium makes it clear RBI has done a good job. As we can see, the announcement of amalgamation and and the moratorium, there was a very short duration, and it says that the job done by RBI is very good in this case. So we have seen Lakshmi Vilas Bank's merger with Singapore-based DBS Bank from different perspective, different angle. For conceptual clarity, we have taken the help of Mint and the editorial of Economic Times and Financial Express, and apart from that, it has made it clear that RBI should have taken decision much earlier and the decisions should have been transparent so that for investors India can be a investor friendly country. That's all for today.